bonds were down. Bonds didn't like this number, but they were still up on the week. Yields fell. One of the only things that really got hit today was gold. Gold got whacked, down about $25 on this jobs number, right back to around 2,000. Just below 2,000 is the support, and that was where we fell to today. Down. Maybe we got to 1,999, 998. Gold stocks got hit, not too hard, because again, I think we're at support. I wouldn't be surprised if we got a little bit further below 2,000, maybe Monday or Tuesday next week. Now, we might not. We might just jump up. I mean, I don't think there's enough downside risk here for anybody to be concerned. Anyone who's buying gold shouldn't worry that they're buying it, I think, at 2002 or 2005. I think that's where it closed.
Peter Schiff discusses the recent fluctuations in the gold market. Despite a dip in gold prices due to a positive jobs report, Schiff remains optimistic, emphasizing that gold is still above key support levels. He suggests that potential further dips could create buying opportunities, cautioning against trying to time the market's absolute bottom. Schiff believes the current trading range might discourage some investors, conditioning them to sell on rallies. However, he predicts a future upward surge, potentially catching skeptics off guard and causing those shorting the market to suffer losses. Overall, Schiff sees the recent sell-off as a temporary setback and encourages viewers to consider the broader market dynamics rather than panicking over short-term fluctuations. Let's dive into the video to hear what he has to say about gold.
I don't think there's enough downside from here to even be concerned about it. I would be more concerned about missing the upside than trying to buy the absolute bottom of a correction. In fact, I think what we're going to be doing here in this trading range is really conditioning people to think that anytime gold rallies, you got to sell it. And I think some of the money that's been on the sidelines, maybe some institutional money that really hasn't looked at gold, when they see it constantly failing at this 2,000 level or even up at 2,100 when we made that new high, they think, well, why bother buying gold? There's no real upside here. And so that's probably keeping people out of the market, which is what a bull market does. It keeps people out, and it climbs a wall of worry. And so every time we get these sell-offs, people get worried. The people that own it gets worried. Oh, maybe this is the top. People who don't own it, don't worry about buying it because they think they're buying the top. Well, one of these days, and I think one of these days soon, it's going to move up and it's not going to stop. And it's going to surprise a lot of people who are afraid to buy it as it keeps rising. And there may even be some people who try to short the market, and they're going to be in for a world of hurt. I mean, they may have made a little money shorting it this time, and so they're kind of getting conditioned to sell into these rallies, but they're ultimately going to get burned by doing that.
In this next discussion, Peter Schiff delves into the discrepancies between the ADP and government job reports, highlighting the recent numbers and their potential implications. Despite a weaker-than-expected ADP report, the government's non-farm payroll numbers for October exceeded expectations. Schiff, however, questions the reliability of these figures, noting downward revisions in prior months. He suggests that the focus on current upbeat job reports may be short-lived, as subsequent revisions could reveal a less optimistic reality. Schiff emphasizes the media's tendency to prioritize the latest numbers, leaving room for potential disappointments in the coming months. Peter urges us to approach job reports with caution and consider the broader context beyond the initial headlines.
But anyway, let me get to the catalyst for the sell-off in gold today, and that was the jobs number. But before actually I talk about today's jobs number that was better than expected, let me talk about the ADP number that we got on Wednesday that was worse than expected, right? So who are you going to believe? Which job report is accurate? The one that the private sector did or the one that the government did? Anyway, so the ADP number, which came out on Wednesday, was supposed to come out at plus 123,000 jobs, and we came out at plus 103,000. And the prior month was revised down a bit from 113,000 to 106. Now, inside the number, we lost 15,000 manufacturing jobs. That's a big loss. And again, those are good jobs. Those are the productive jobs that we need, and they have higher pay. Probably the people who lost those manufacturing jobs, well, maybe they got a couple of part-time jobs working, in a restaurant, or in a hotel or doing something just to get a paycheck to replace the paycheck that they lost. But they need 2 or 3 jobs, and that's, the story of this so-called strong labor market is people replacing good jobs with multiple bad jobs. But this was not a strong number. In fact, one of the interesting things about it was that we lost jobs in leisure and hospitality. And that was the first time, maybe in a couple of years, since we reopened after COVID, that we lost jobs in leisure and hospitality. That's mostly, I think, hotels. People working in those, so maybe travel is down a bit. But, that was a sign that, where the jobs have been coming from, that's been the big engine of low-paying jobs, leisure and hospitality, and now it's sputtering a bit because it lost jobs. So we got that report that was lower than expected. And that maybe set the stage. Maybe some people thought we would get a weaker than expected government number, the non-farm payroll number for October. And the consensus was for 180,000 jobs. And we got 199,000. So it was a beat. Now, of course, they did revise down the prior couple of months. I think they took about 35,000 jobs off the last couple of months, which if you compare that to the amount of the beat, it's very, very possible that next month, because I think every job number save one of the year, every single one. I think there was one time where we didn't downwardly revise the prior month. So to take this month on face value, because we beat by 19,000 jobs, and say, hey, look, we created more jobs than we thought, it is very likely that by next month, they're going to revise this month's number lower. And so it wouldn't have been a beat. It would have been a miss. But no one's going to care because they're going to be focusing on the December number, which may be another beat that gets revised to a miss in January that nobody cares about because everybody forgot about December and now they're looking at January because the media always pays attention to the number that's just reported. And so a month from now, if they revise the number that we're so excited about now and we find out that we were excited for no reason because the number was wrong, that's already old news. Everybody focuses on the new number.
Today, we navigated through the twists and turns of the financial landscape with Peter Schiff. We explored the intriguing dynamics of the gold market, dissected job reports, and uncovered the nuances between private and government sector data. If you found this analysis insightful, don't forget to subscribe for more updates, hit the like button to show your support, and share your thoughts in the comments below.